So I get asked all the time, what do I do when I'm worried about the market? That all of my calls or all of the ideas that I put out there are mostly to the long side. And when Stats Edge Pro launches this weekend, we are going to have a whole bunch of algorithms currently all focused on the long side. So what do I do when there's a potential bear market coming or there's something that I'm worried about in the market? So that's something that I'm going to talk about today. Now, the reason that I'm going to use this method as opposed to just simply shorting weak stocks or shorting bad stocks is one, I've recorded my statistics. I'm not the best at shorting stocks. It's just not something I'm good at. It's a different skill set, and that's okay. When I'm building statistics that are going to be available in Stats Edge Pro, which you can find at statsedgetrading.com, the it's very hard to build back tests because the market generally drifts up over time. The other reason is I do a lot of my trading and investing in what tax advantage accounts. So RRSPs in Canada, IRAs in the States. The idea is you're not allowed to short. So with all of those combined, we're just going to talk simply about looking at inverse ETFs. Now, the reason I'm doing this video today is because as we broke down, I'll zoom in a little bit, as we broke kind of this candle's low right here, I took on and bought a little bit of this SQQQ. Now, what this is an inverse of the NASDAQ, the QQQs that we all know and love. The reason I took it here is we had a nice, strong earnings report, or not earnings report, some sort of you guys know me. I don't focus on these report. Let me move this a little bit. But a nice economic data, we'll say. And we had this massive spike down in the market. Let's actually bring up the cues. It's going to be easier to see here. We had a big pop in the market on this news. It looked amazing. This news looked fantastic, whatever it was. And then as the pre-market continued, we sold right back down, and then we broke pre-market lows. And we put in this big, ugly red candle. So if we go to the SQQQ, it was after that red candle. I was at my desk, I was watching, and then I bought a little bit in through here. You can see as we're doing this, which is still a couple hours at the end of the day, we are breaking at these highs. Now, so the reason I use these as opposed to just shorting the NASDAQ is you can see that there is leverage. So these are the Ultra Pro. Now, I'm going to tell you the benefits, and I'm also going to tell you to be careful here, but there are Ultra Pro longs and there's Ultra Pro shorts, and tons of these. So let's go to FAZ here. So FAZ is the 3 times bear ETF. If we go FAS, this is going to be the 3 times bull ETF. So if the Q or if the financials are pushing up, this is going to have 3 times the average daily return. And that's going to be very important. We're going to hit on this one, the average daily return. So we're up 2.4%. So if we go to XLF, we're going to be up roughly a third of that, right? 0.79%. But you can see this is actually closer to these highs right here. We talked about financials on a recent video that I did, but you can see these are closer to highs than that. So why is that the case? So let's talk a little bit about these instruments. First of all, the massive advantages of them. I can hedge a portfolio. Right now, I'm very long stocks. We've been talking about this forever. Been bullish on the market. A lot of the algorithms that the premium members are going to get access to have just been printing, buy this, buy this, buy this, hold this. I have a very long portfolio right now. So when I saw this, as opposed to panicking, selling all those longs that are doing fantastically, I can simply buy and allocate less of my capital because it has leverage on it to take this trade. So I'm not using the leverage to say I want to, hit harder and I want to really leverage into a position. I'm using the leverage to say I can take the same risk and apply less capital. And I'll do that from time to time. I actually did that same thing right back here. I remember I did the same thing right here and got stopped out pretty quickly. But I can take these discretionary trades to the short side to hedge my portfolio so that when the market is down, these names are up bigger than the other one. That's the idea. So I use these double and triple leverage ETFs to take very discretionary trades to say, I think that we could be pushing a couple days down here on the Qs. I'm not saying it's 2008 or the tech bubble or anything like that, but we could be getting a little bit of a relief sell-off in the Qs. So that would cause us to go up for a couple days. So if I take a small amount of my portfolio and I take this trade knowing that if we just reverse tomorrow and we go back to highs here, I'm wrong and it's time to move on. If we do get some sort of crazy flush and we come back to this price right here, great. I can take the profits from that trade, and at the same time I'm building a list of stocks that I may be interested in getting involved in when we hit that price and when that price turns. So that's why I'm using them. Now I want to talk about the risk of these. You have to know the risk of these securities. And this particular one I think is the best example that I can think of offhand is this Labu. Now, if we zoom way out here and we zoom, we could go even further out, but I think this expresses a lot of the point right here. This security was never $3,500 a share. It was never at this price. What happens is these are meant to push lower over time. All of these instruments, these double leverage and the triple leverage, especially even more so, are going to move lower over time. It's just the way it works. They're going to sell off as the market just over time, regardless of what the market does. And the reason for that is that they have derivatives. They're holding these derivative securities, and these derivatives decay over time. So that's the risk of these securities. Yes, double leverage can just hurt you just because it's going to move around a lot, but these will degrade slowly over time. It's an absolute certainty. It's not a bug, it's a feature. So know that these are for short-term tactical moves like we're seeing here on the SQQQ, where I think that there's a potential little bit of a sell-off, a little bit of sell-off you could call. Here, you could also see this in the SQQQ. This is $400,000 a share. Of course, it was never $400,000 a share. But I think that we could, maybe push down to this point right here or something like that. Short-term tactical trade and move on. Do not hold these, either the long or the short ones, for the long run. As we saw with the XLF, you were better just holding the underlying instrument. So I hope this helps you. If you are like me and you're mostly trading from the long side, take a look at these when you start to get a little bit worried about the market. Take a small systematic trade, have a stop loss for it. You're going to either lose some money, which means the rest of your portfolio is going to go higher, which is great, or you're going to make some, which means the rest of your portfolio is going to probably go down, which isn't so great, but at least you were able to hedge some of that risk.